Is international emissions trading poised to make a comeback? Given a lot of the controversy that has been caused by things like carbon offsetting, would that necessarily be a good thing? We're going to explore answers to these questions in today's episode of Climate Mundial's Energy and Climate Weekly. So let's get right into it. News broke last week on Bloomberg suggesting that the European Commission is considering a plan to allow the use of international credits towards a newly proposed climate goal of a 90% reduction in emissions by 2040. This includes the potential use of international certificates for acquittal of compliance obligations for firms within the European Union's emissions trading system, or EU ETS. Now, this would represent a major change in policy. The European Union was once a key driver of demand for international carbon credits for compliance purposes alongside Japan. It was prolific during the Kyoto Protocol first commitment period from 2008 to 12, but began phasing out the use of these credits in the emissions trading system from 2013 right through to 2020. From 2021 onwards, the bloc decided no longer to engage outside of its geographical boundaries and became a de facto island for committing its Paris Agreement commitments until now. The main reason cited in the Bloomberg article for the possible change in policy is to reassure member states who are concerned about the cost of reaching an ever more ambitious climate policy that there will be containment provisions in place. And the proposed 90% cut in emissions by 2040 certainly is ambitious. This video, based on a column I published on Substack a week ago, will examine the case for and against emissions trading internationally. There is a link to the column in the description below. While it is structured around the policy choice that is before the European Union, it serves as a blueprint for any country's consideration of the opportunities that international trade in emission certificates affords. So first of all, let's look at the case for international emissions trading. The atmosphere does not discriminate against emission reductions or removals based on the national borders within which they occur. Climate benefits exist irrespective of location. The fact that we have limits in trading at all within global efforts to deal with climate change is really nothing to do with the environment. It's more of a reflection of the political subdivisions that currently prevail in the international system. Indeed, the Paris Agreement on climate change is an accord between countries. Countries decide policies for themselves and take responsibility for emissions that occur on their sovereign territory. Emissions occurring in other countries are the responsibility of those countries. So the first point to make is that decisions to restrict international emissions trading are part of a political choice. The next point to make is that the magnitude of the effort needed to deal with climate change globally requires that the private sector does most of the investing. Private sector engagement is an imperative, not an option. Public budgets simply do not have the resources needed to invest at sufficient scale to solve climate change, nor are governments the entities who have operational control over most emissions-intensive production activities, albeit with some exceptions for state-owned business enterprises. In this respect, by allowing firms as much possible flexibility to locate and implement emission reductions, the costs of meeting environmental goals can be reduced. This is because flexibility allows firms to search the world, identify and then implement emission reductions and projects where the costs are lowest. The result, if the system is well organized and recognizes the same standards, more on standards a little bit later, can lead towards convergence in global carbon pricing. Private sector entrepreneurship and innovation is stimulated far more powerfully when there are opportunities and economic rents to be captured than when certain activities are prohibited by regulation. So the next point to make is that there is a strong economic justification for allowing international emissions trading. international trade is not a zero-sum game. If you have two parties and one agrees to buy an item and another agrees to sell it, provided the transaction is voluntary, each party adheres to its contractual obligations and there is no harm caused to third parties by the trade, everyone is better off as a result. If they were not, there'd be no good reason to enter into the trade in the first place. There are also other co-benefits for the countries themselves. On the sell side, the countries where emission reductions are produced benefit from development and the accumulation of foreign investment and currency inflows, as is the case in any other export-based industry. On the buy side, countries importing credits benefit from lower compliance costs with meeting climate targets and can then afford to be more ambitious with their climate goals. Therefore, international trade is not a zero-sum game where one party to a transaction must win and another must lose. The principle applies to emissions trade as much as it does to any other kind of commerce. The situation has been brought into focus in the last few months even more so, with the United States withdrawal from the Paris Agreement, followed not long after by the introduction of reciprocal tariffs. While there is potential for a country with an economy as large as the United States to influence others with its trade policy, there is a general understanding emerging that negatively affected countries would be well served by adopting policies that promoted international trade now more so than ever before. So, provided adequate safeguards are in place to protect third parties from harm, there is an overall welfare benefit for countries from international emissions trading, particularly ones that are still committed to the Paris Agreement. Of course, there may be other benefits, though these are the salient ones. What do you think about them? Are there any others that you think should be in there? Let me know what you think in the comments section below. This now rounds out our arguments in favour, so let's get on to considering the case against international emissions trading. Greenhouse gas emissions are a de facto pollutant that can cause harm to the environment and indeed to other people who had no responsibility for their generation. Economists often describe greenhouse gas emissions as a negative externality, which is a cost that must be met by society, whereas parties responsible for their generation are not charged. If we know that emitting greenhouse gases is, on the balance of probability, going to cause harm to other people, is it not reasonable for citizens of the world to expect that firms will work to eliminate those emissions altogether as quickly as possible? Is it reasonable for firms to continue with emissions-intensive activities in the face of all the scientific evidence that the emissions are risking environmental and social damage? Would emissions trading not allow those externality-creating activities to continue without constraint and just be offset by the purchase of certificates from somewhere else? Or is there an equally valid counter-argument that decarbonising too quickly will put at risk employment, investment, economic and financial stability and the livelihoods of people, the social impacts of which could jeopardise the pursuit of sustainable development and efforts to raise living standards? Different people may have different answers to these questions, though it is clear that there is a moral dimension to this argument. For emissions trading to be credible, the standards adopted must ensure that the tradable certificates are not issued to projects that would have happened anyway, often called additionality in the carbon policy sphere. It is also important that baseline scenarios of emission reductions are not set too high, the consequence of which would be to award more credits to projects than emissions have actually been reduced. The same can be said of the standards used by firms to measure and report the emissions they contribute each year, which become the basis on which firms' liability to purchase certificates is determined. Equally, there must be an effective system that ensures that once certificates are transferred from one party to another, especially where the certificates leave one country and enter another, that they are not counted twice. So, we can say that the standards used in international emissions trading are very much at the core of its environmental integrity. If there is no environmental integrity, or if the environmental integrity is not credible, the entire system's credibility suffers. Aligned to the discussion of standards, allowing for liberal emissions trading between countries in some cases could actually encourage gaming of the system or even free riding by some countries. For example, if a country were hoping to sell lots of certificates, it would face an incentive to set baselines as high as possible, which would lead to more carbon credit production. There was a general problem under the Kyoto Protocol where many believe that developing countries, without binding emission limitation commitments, had no real incentive to introduce ambitious emissions or climate policies. This point is rightly contested in the international domain, though to be comprehensive, this video would not be doing an effective job were it not to discuss the matter. So one can say that emissions trading, in the absence of robust and universally supported standards, risks the creation of incentives for some countries to free ride in the global system for dealing with climate change. It is important to also be aware of the broader international relations dynamics that provide a backdrop for climate change cooperation. Emissions trade can lead to wealth transfers from some countries on the demand side of the market to those on the supply side. In a recent working paper called The Prospects for International Emissions Trading under the Paris Agreement, What Experience with the Kyoto Protocol Says About the Influence of Relative Gains, the wealth transfers during the Kyoto First Commitment period from a selection of group of 7 countries to the 5 original BRICS countries was shown to be about double that of the economic savings that those countries achieved from the trade. Some countries can be particularly sensitive to relative gains, especially when those gains accrue to countries with whom there is intense competition. Relative gains can be mitigated, though, through mechanisms like ensuring that there is participation in underlying investments that lead to the creation of carbon credits, though without them, wealth transfers can represent a challenge. Global efforts to tackle climate change have their origin in an ambition to achieve sustainable development. The seminal Brundtland report, Our Common Future, defined sustainable development as, quote, development that meets the needs of the present without compromising the ability of future generations to meet their own needs, end quote, irrespective of country or region. While it is true that a handful of the largest and most powerful countries emit the most greenhouse gas, and are worthy therefore of particular focus, there is a risk that international emissions trading leaves some countries behind. During the Kyoto Protocol, for example, markets focused on projects and certificates coming from the largest sources of emissions. Unsurprisingly, the majority of projects on the supply side occurred in the countries with significant industrial emissions like China, India, Brazil, South Korea, and Russia. In some respects, a functioning and rational market would be expected to do exactly that. However, there were few, if any, safeguards put into place to encourage an even geographical distribution of projects. As a result, some countries in the greatest need of finance for sustainable development, like least developed countries, small island developing states, or countries within the African continent, either missed out on a lot of the opportunity or they arrived in the market too late to reap the benefits. Without mechanisms to incentivize investment into these kinds of countries, international emissions trading is at risk of criticism for failing to achieve an even geographical distribution of the benefits. As was the case with the arguments for, there may be other arguments against international emissions trading. But what do you think about the arguments that have been raised here? Are there any others that you think should be in there? Let me know what you think in the comments section below. But now it's time to summarize. The task that lies before the European Union to decide whether or not to open up its economy to international emissions trading is a significant one. industrial competitiveness is becoming a major issue for the bloc, and the Commission would not likely want the 90% emission reduction goal to add to these challenges. Indeed, the Draghi report, published in 2024, highlighted the pressing need to reduce regulatory burden in the European Union. Allowing greater flexibility to achieve ambitious climate goals arguably fits with the spirit of the Draghi report, and the Bloomberg article highlights the concerns of some member states. New rules for international emissions trade agreed at the 29th Conference of the Parties to the United Nations Framework Convention on Climate Change in Baku, Azerbaijan in November 2024, provide a possible basis for overcoming at least some of the arguments against trading that have been considered in this article. Unlike the Kyoto Protocol, the Article 6 mechanism of the Paris Agreement and its project certification system called the Paris Agreement crediting mechanism is universal, and the opportunity to host projects and produce certificates, or to use the certificates to help meet climate goals, now rests with both developed and developing countries. Before the European Union's reported move into this area, only a handful of small and relatively wealthy countries like Switzerland and Singapore had previously declared an interest and a commitment to engage in international emissions trading on the buy side of the market and to use those certificates for compliance with their climate targets. The European Union's possible re-entry into this market would therefore represent a step change in the development of the market itself. Addressing the main arguments against emissions trading, as highlighted in this video, is most efficiently and effectively undertaken when countries work together. Everyone, not just countries but also citizens, has a shared interest in this being a success. Overcoming the challenges identified in the Kyoto Protocol era will be paramount. Let me know what you think in the comments below. Thank you for joining me today, and I look forward to seeing you in the next episode of Climate Mundial's Energy and Climate Weekly. Bye for now.